Yo, what's up, guys? So today I just wanted to go over a video discussing the 9 EMA moving average across multiple time frames, and I just wanted to kind of go through this and explain some theories behind it and why it's so important and why we use it here at Livestream Trading. The 9 exponential moving average is a moving average that we use, and I use specifically to gauge extension on a chart. As a day trader, the last thing you want to do is, chase a chart, chase a setup that's, extended to the upside, right? You don't want to chase something way up here when you see that the 9 moving average is way down here, right? How we use it is the further away your price action is away from the 9 moving average, the less likely that you're going to get continuation upward, right? The flip side of that is when you're buying a stock that's closer to the 9 moving average, then you're buying a stock that has more potential to go up, right? So how I use the moving average is I always want my stocks and my setups to be very, very close to riding the 9 moving average. And that's going to be across multiple time frames. That's how you get the big setups, because I think that people fail to realize that there's more traders out there, types of traders, than just day traders, right? Where there's investors, there's swing traders, there's scalpers and all this stuff. So they're not just looking at a 1 minute chart, watching each tick go by. They're not just sitting here watching all this action in here. They're looking at daily charts, 12-hour charts, 4-hour charts, 1 hour, 15-minute charts. And so the idea is that if you can get into a stock that's has volume, showing there's buyers involved, and that if you can get into a stock that's green on the day, buyers are getting involved, then and you buy that stock that's near the 9 moving average on multiple time frames, then your potential for upside is very high, because the stock is fully rested and it's ready to go higher, and it's already pushing volume, and it's already green on the day, and everyone's looking at it. Here's a kind of a weird one. So APWC, you can see that here's kind of like a flag right here, right? So it's fully corrected on the 5-minute, fully corrected on the 15-minute, right? Actually, this is a pretty decent little 15-minute setup here, 5-minute setup. But me personally, I probably wouldn't have taken this one, just because looking at the hourly chart, look at how far away it is, right? Far away from it. It's opening way up here. There's a big gap between the candlestick and the 9, right? But if you see the gap here between the hourly chart, you know that the potential for upside is a little bit lower now, because the hourly chart time frame players aren't going to be getting involved, right? 15-minute chart players are going to get involved, 5-minute chart players are going to get involved, but we're not going to have as many hourly chart, 4-hour chart players getting involved. Because why? Because you can see the extension on the there's the 4-hour chart and then the hourly chart. The further the candles are away from the 9 EMA on the less likely for upside potential. So just keep that in mind. When you're tempted to buy a stock that the hourly chart is this extended on the afternoon, it hasn't corrected yet. It may have worked this time, but over time we've tracked these setups, and the win rate goes down the more extension there is. So just keep that in mind. The more extension there is from the 9 EMA on multiple time frames, the less likely you're going to get follow through. The closer the candles are to the 9 EMA on these 3 time frames here, the better, right? The more upside potential. So, all right, guys, I'm going to wrap it up here. I hope you enjoyed it. It's a quick video, and if you have any questions, you can always reach out to any of the mods, myself, Jeff, anyone that's here. We're here to help. All right, so hope you enjoyed it, and see you in chat.